The hidden global debt reset. Nobody is talking about something massive is happening to global debt right now. But it's not a crash, it's not a default, and it's not in the headlines. It's a reset, a silent reset. For decades, governments, corporations, and households have borrowed more and more money. Global debt is now over $300 trillion, according to the Institute of International Finance. That's more than 3 times the size of the world economy. But debt itself is not the real story. The real story is how the world is trying to erase that debt without anyone noticing. Normally, debt resets are loud and chaotic. Think about the Great Depression. Think about Latin American debt defaults in the 1980s. Think about Greece in 2010. Think about banking collapses. Those were visible resets. This one is invisible. To understand this, we need to go back in history. After World War II, many countries had debt above 100% of GDP. The United States peaked around 120% of GDP in 1946. The UK was even higher, but they didn't default. Instead, they used inflation and controlled interest rates to shrink debt slowly. This policy is called financial repression. Here's how it works in simple terms. If inflation is higher than interest rates, the real value of debt falls every year. The government pays back debt with money that is worth less. Let's use a simple example. Imagine a government owes $1 trillion. Inflation is 5% per year, and interest rates are 2%. That means the debt is shrinking by 3% per year in real terms. After 10 years, that debt is worth about 30% less in purchasing power. No default, no crisis, just math. This is exactly what happened after World War II. From 1945 to the 1970s, inflation quietly erased a huge portion of government debt. Savers paid the price. Governments benefited. Fast forward to the 1970s. Inflation in the US peaked above 13% in 1979. Bondholders lost massive purchasing power. Homeowners benefited because their fixed-rate mortgages became easier to pay. Debt melted away in real terms. Now look at the 2020s. After 2020, governments printed trillions of dollars to stabilize the economy. In the US alone, more than $5 trillion in fiscal stimulus was deployed. Central banks expanded their balance sheets by tens of trillions globally. Inflation followed. In 2022, US inflation peaked above 9%, the highest in 40 years. Europe and many emerging markets saw even higher numbers. Interest rates were raised, but for a long time, real interest rates were negative. That means inflation was higher than what savers earned. This is a debt reset in slow motion. Another hidden mechanism is maturity extension. Governments are issuing extremely long-term bonds. Some countries issued 50-year and 100-year bonds. That means debt technically remains, but the burden is pushed far into the future. Politically, it feels painless. Economically, it transfers the problem to future generations. We've seen this strategy before. After the Great Depression, many debts were rolled over and extended. After the 2008 financial crisis, central banks bought massive amounts of government bonds, effectively turning private debt into public debt. Today, central banks still hold trillions in government securities. This creates a unique situation. The government owes money to itself. This is another quiet reset. Corporations are also part of this system. During the 2010s, companies borrowed at historically low rates. Some issued debt at 1% to 2% interest. Inflation now reduces the real value of that debt. Companies with strong pricing power can raise prices and inflate away their liabilities. Households are affected too. If you have a fixed-rate mortgage at 3% and inflation is 5%, your real debt is shrinking every year. This is why inflation often benefits debtors and hurts savers. So who loses during a debt reset? People holding cash, people holding low-yield bonds, people relying on fixed income. Inflation is essentially a wealth transfer from creditors to debtors. This is why investors are moving into stocks, real estate, commodities, and alternative assets. They are trying to avoid being the ones paying for the reset. And here is the part nobody talks about. A sudden debt crisis is politically dangerous. A slow inflationary reset is politically invisible. People protest bank failures. People protest defaults. People rarely protest 3 to 4% inflation. So policymakers prefer the quiet path. This doesn't mean hyperinflation is coming. It means the system prefers gradual erosion instead of collapse. Look at Japan as another historical case. Japan has had debt above 200% of GDP for years. Instead of defaulting, it kept interest rates near zero for decades. Inflation was low, but debt was controlled through policy and domestic ownership. Different strategy, same goal: avoid a visible reset. Emerging markets show the extreme version. Countries like Argentina and Turkey have repeatedly used inflation to reduce real debt burdens. Savers suffered. Governments survived. Now we are seeing a global version of this strategy, but in a controlled and coordinated way. In the next decade, the global debt reset will not look dramatic. It will look boring. It will look like normal life. Prices slowly rising, currencies slowly weakening, debts slowly shrinking in real terms, asset prices slowly adjusting. History shows this is one of the oldest financial strategies in the world. Governments rarely default when they can inflate. And once you understand this, you see the system differently. The real question is not whether debt will reset. It already is. The real question is, are you positioned as a debtor or as a creditor? Because in every debt reset, someone pays and someone wins. And the hidden reset happening right now is designed so most people never realize which side they're on. Now that we understand how the debt reset works, we need to ask a deeper question. Who is really controlling this reset? Because debt is not just an economic tool, it is a political tool, and it is a power tool. Historically, the countries that controlled debt cycles controlled global influence. In the 19th century, the British Empire financed much of the world through London banks. Countries depended on British capital. That gave Britain enormous geopolitical leverage. In the 20th century, the United States replaced the UK. After World War II, the US dollar became the global reserve currency, and US Treasury bonds became the world's safe asset. That allowed the US to borrow more cheaply than any other country in history. This system is called exorbitant privilege. It means the US can print debt that the world wants to hold. But even this system has limits. By 2025, US federal debt surpassed $34 trillion, and total US debt, including households and corporations, exceeded $100 trillion. Globally, total debt surpassed 300% of world GDP. These are historically extreme levels. So how do you reset debt without breaking the system? One method is currency dilution. Another is controlled inflation. Another is yield curve manipulation, where central banks influence interest rates across maturities. Another is financial repression, forcing institutions to hold government bonds. These tools sound complex, but the effect is simple. Debt becomes easier to manage. Savings become harder to protect. A powerful historical example is the 1940s and 1950s in the United States. The government capped interest rates on bonds while inflation ran higher. Banks and pension funds were forced to hold government debt at low yields. Over 2 decades, US debt to GDP dropped dramatically without defaults. Another example is Europe after the Euro crisis. The European Central Bank launched massive bond buying programs. This kept borrowing costs low for heavily indebted countries like Italy and Greece. The debt didn't disappear. It was stabilized and slowly diluted. China provides another unique case. Much of China's debt is internal and state-controlled. Banks are state-owned, companies are state-linked, and savings are directed into government projects. This allows China to roll over debt without market panic. It's a different form of hidden reset. So what does this mean for normal people? Let's use a simple analogy. Imagine you owe $100,000 on a mortgage. If your income doubles due to inflation, but your mortgage payment stays the same, your debt becomes easier to pay. Now flip it. Imagine you saved $100,000 in cash. If prices double, your savings buy half as much. Same economy. 2 completely different outcomes. That is the core of every debt reset. Debtors benefit, savers lose. This is why real assets matter during resets. Stocks represent companies that can raise prices. Real estate rents adjust with inflation. Commodities respond to scarcity. Gold historically protects against currency dilution. Even infrastructure assets generate cash flows tied to economic activity. Cash and bonds, on the other hand, are promises, and promises are easy to change when debt is too high. Another layer of the reset is demographics. Aging populations in the US, Europe, and Japan mean fewer workers supporting more retirees. Governments will need more spending on healthcare and pensions. Historically, countries under demographic pressure prefer inflation over austerity. It is politically easier to dilute money than cut benefits. Technology also plays a role. Automation and AI increase productivity, but can concentrate wealth and create inequality. Governments may respond with higher spending and social programs, increasing debt further. Again, inflation becomes the quiet solution. Now, here is the most important insight. Debt resets are not rare events. They are recurring cycles. History shows 4 main ways debt resets: default, inflation, financial repression, economic growth. Default is politically painful. High growth is uncertain. So governments prefer inflation and repression. We are currently in that phase. The next decade is likely to be defined by managed debt erosion, not sudden collapse. Central banks will try to keep inflation slightly above target. Governments will continue rolling over debt. Institutions will continue absorbing bonds. To most people, nothing dramatic will happen. But purchasing power will change. Wealth distribution will change. Asset prices will change. The biggest risk is not a crash. The biggest risk is standing still while the system moves. So when you hear that global debt is unsustainable, understand this. The system will not break. It will bend. It will reset slowly. And just like every reset in history, it will create winners and losers. The hidden global debt reset is not about panic. It is about positioning. Because when the reset is silent, the people who notice it early are the ones who adapt.